This short tutorial provides an introduction of the balance sheet. We'll explain the purpose of the balance sheet and why the balance sheet always balances. The balance sheet, also known as Statement of Financial Position, is a snapshot of the financial status of an organization at a point in time. Accountants talk about both sides of the balance sheet. On one side of the balance sheet are the assets of the company. On the other side of the balance sheet are the liabilities and owner's equity of the company. Both sides of the balance sheet balance around this equation. Assets equals liabilities plus owner's equity. The asset side of the balance sheet refers to the assets that the company controls. The liabilities and owner's equity side of the balance sheet provide details on the ownership of the assets. Some company assets are secured on liabilities. The company has borrowed money to acquire control of the assets. Other assets are secured on the equity of the owners. This means these assets are owned by the owners. So in summary, the reason the balance sheet balances is that assets the company controls can only come from one of two sources. Either the company bought the assets with its own money, or the company borrowed to buy the assets. We will now demonstrate how various transactions impact the balance sheet. Let's take an example of a startup company. The first transaction we look at is the owners of the company investing $100,000 in company shares. In this transaction, the owners receive shares in the company, and at the same time, the owners lodge $100,000 cash into the company bank account. After this transaction, the company balance sheet shows an asset of $100,000. This asset is cash. On the other side of the balance sheet, the company recognizes owner's equity of $100,000. The owner's equity is the equity put into the company by the owners. Note that the owners could have given a loan to the company. This is called a director's loan. The loan would be repayable by the company to the directors. In this transaction, the owners lodge $100,000 cash into the company bank account on the understanding that this $100,000 will be repaid to the owners in the future. After this transaction, the company balance sheet shows an asset of $100,000. This asset is cash. On the other side of the balance sheet, the company recognizes a liability of $100,000. This liability reflects the obligation of the company to repay the loan to the directors. We'll continue this tutorial on the basis that the owner's $100,000 investment is in shares and is not a loan. In the second transaction, the company purchases $75,000 of inventory for cash. This transaction is represented on the asset side of the balance sheet. We reduce the cash amount by $75,000 to reflect the payment to the supplier in cash. We increase the inventory amount by $75,000 to reflect the cost to the company of the inventory purchased. No liabilities are incurred as we paid in full for the inventory at time of purchase. There is no change to equity. In the third transaction, the company purchases $35,000 of inventory from a supplier. This inventory is purchased on account. This means that the supplier has not yet been paid for the inventory. The company receives delivery of the $35,000 of inventory. The supplier submits an invoice for this amount to the company. As the company is now in control of this inventory, the inventory is recognized as an asset of the company. The inventory value is measured at cost of $35,000 on the asset side of the balance sheet. Since the company has not paid for the inventory, a liability of $35,000 is recognized on the liability and equity side of the balance sheet. The company has received the good and an invoice from the supplier, so the company has an obligation to pay for the goods. In the fourth transaction, the company sells products to customers for $120,000. The company issues an invoice to the customer for the full amount of the sale. The customer does not pay the company immediately. The products that are sold cost the company $100,000. We'll deal with the balance sheet impact of this transaction in two stages. Firstly, we recognize an asset on the company balance sheet of $120,000. This asset relates to the sale of products to customers who have not paid us yet. This asset is classified as a debtor or as accounts receivable. This $120,000 is also recognized as retained earnings. Secondly, the company must recognize the cost of the goods that were sold. On the asset side of the balance sheet, the company removes the cost of the inventory sold. This cost is $100,000. This cost of $100,000 is charged as a cost of goods sold expense on the income statement resulting in a reduction in retained earnings of $100,000. In the fifth transaction, the company collects $30,000 cash from customers. This cash relates to products that have been sold on account to the customers by the company. On the balance sheet, the company reduces the value of accounts receivable by $30,000. The company also recognizes the cash received of $30,000. In the sixth transaction, the company pays $3,000 in cash to a supplier. This cash relates to products that were purchased on account from the supplier by the company. On the asset side of the balance sheet, the company reduces the cash by $3,000. This reflects the cash paid to the supplier. On the liabilities and owner's equity side of the balance sheet, the company reduces the value of the liability to the supplier by $3,000.